for the she's in his usual hiding hole. How long are you in for?
About an hour. Good morning, everybody, and thank you for joining us on today's webinar. I do hope that you're all keeping safe and well. First of all, before we get started, just a little bit of housekeeping. We are all still working remotely, so we do apologise in advance for any unplanned disturbances. My extension's still continuing, the windows and doors are being delivered today, so my dog Archie may very well make an appearance at some point, so I do apologise if that happens. Also, just to let you know, you're all on mute and your cameras are switched off, so you can see us, but we can't see you. There is a facility to ask questions by typing them into the Q&A box at the bottom of the screen. We will try and answer them on the webinar if time allows, but if not, we'll follow up after the webinar with you. So don't worry, if we don't answer your question, we're not ignoring you, we will get back to you. The last webinar we did was on health, wealth and wellbeing, and we had Dr. Susie Mitchell sharing some tips on coping with the strange world that we now live in. And the feedback from that session has been excellent. All the recordings from previous webinars are going onto our new YouTube channel, so please do take a look on there. You can find the recordings, or you will be able to find recordings of the previous webinars that we've done, and also any videos or content that we're putting out going forwards. And you can find us on there by searching Oakmere Wealth. Now, on to today's topic. As I'm sure you've seen in the news, one of the positive impacts of the coronavirus pandemic has been the reduction of pollution and emissions. However, the global shutdown has barely dented our carbon emissions. The latest analysis shows we've seen a fall of 6 to 8% because of the pandemic, but we need a drop of about 10% to have a noticeable effect on the rising CO2 concentrations. We've seen some awful examples of the climate crisis in recent years, with the Australian fires in 2019-20, the Venice floods in 2019, and the California wildfires in 2018. One of my passions is that we should be investing responsibly. We should be looking to achieve financial well-being in a world worth living in. So what is responsible investing? Responsible investing is the consideration of environmental, social, and governance factors, or ESG factors, when making investment decisions. A recent study found that pensions invested in sustainable funds can be 27 more times effective in reducing the carbon footprint when compared to other ESG activities. Our aim is to integrate ESG across our investment proposition and to ensure that our investment managers are actively engaged. It's about opening up the conversations around ESG issues and encouraging companies to address these issues. At St James's Place, they've set minimum standards for our fund managers. And to fulfil our minimum standards, managers will engage with the companies they invest in around ESG issues. Now, I just want to play you a very short video featuring Robert Gardner, who's the investment director at St James's Place and is a champion for responsible investing. So hopefully the technology is going to work. Just bear with me.
There's no doubt as we look to the future that capitalism needs to become more purposeful. It needs to really think about its impact, not just being about the extraction of value for the creation of profit, but think about its impact on the planet and in the environment. And at the highest level, that's climate change. Now, the amazing thing is, and again, this is one of the reasons why I joined, is that if you or I invest our pension fund or our ISAs in a sustainable way, that can have 27 times the impact of reducing our carbon footprint than if we fly less, eat less red meat, cycle more. So when you invest your money, you can make that money a real force for good. And the magic of St James's Place is a bit like compounding. So you take all of your clients' money and you aggregate it together, and we have over £100 billion. And that gives us real scale and influence, whether it's with BlackRock or any one of our other 39 fund managers around the world. They have an aggregate amount of money that they manage of about £8 trillion. And they invest across £60 trillion worth of companies and properties and bonds across the world. So we can help someone investing their money in Bristol, aggregate it up into St James's Place, influence the largest fund managers in the world, and really make that money a force for good. And it's pretty simple, really, because wealth and prosperity is only worth something in a world worth living in. In 2050, I'll be 72, my daughters will be 36 and 33, and if we've trashed the planet, there's no point in having £1 million. So we better get it right.
So the concept of using money as a force for good really is fascinating, and it just shows the difference that we can make. Rob's an excellent speaker, and I've seen him perform a couple of times now, and he really does make you think about using money in a way that is more responsible going forwards. So on to today's speaker. Today we're lucky enough to have James McEvoy from Rowan Dartington joining us. Rowan Dartington are a discretionary fund management solution which are available to our clients. They were founded in 1990 and are one of the UK's leading providers of personalised investment management. They work closely with us to provide truly bespoke investment solutions and stockbroking for our clients. James McEvoy has been managing investments for 14 years. Initially as a fund analyst and fund manager specialising in multi-manager funds and alternative investments before moving into private client fund management in 2011. He now works as an investment manager assisting St James's Place partners with the creation of bespoke investment solutions for their clients. So I'm just going to switch this over to James. Are you there, James?
I am. Thanks, Carla. There we go. Good morning, everyone. Thanks for having me on. I'm just going to share my screen so you can view the slides that we're going to go through today. Hopefully that's worked for everyone. Okay. Yeah, thanks for having me on. It was a good introduction there from Carla, and having Rob Gardner on was quite a treat. Actually, he sets the scene for why we're trying to do what we do with responsible investment, and why it is not just important now, but going to be really important as we move forward into the future. Carla touched on the things we've seen during the COVID-19 pandemic, the reduction in air pollution, and I also think there's been much more of a community feel, certainly around where I live, which helps along the providing a better society for the future, which is another one of the factors that we look for when we invest in ESG portfolios. So I'm just going to set the scene first and show you some of the impact that humans have had on the environment, particularly over the last sort of 60 years or so. And then we'll move through how we go about responsible investment portfolios. And then we'll just touch on what's going on in the market at the moment and why it's important to have a longer term view. So this slide's called the Great Acceleration, and there's quite a lot of charts on there, but you can see the generic trend in all of the charts. And on the top half of the screen, you've got things like world population, which Rob mentioned how old he and his daughters will be in 2050. At that point, the world population is estimated to be around 10 billion people, and that's going to bring a whole host of challenges, especially around things like food production, which we already struggle with in certain parts of the world today. And then you've got things like primary energy usage, water usage. And if you look at the charts, the scale of these have increased in the last 50 to 60 years. It's quite staggering, really. And on the bottom side, the sort of lighter green charts, this shows you the effect of the top charts are having on the natural world. So carbon dioxide, nitrous oxide emissions are peaking. Surface temperature, we know, is increasing rapidly. The oceans are becoming more acidic. And we are destroying the tropical rainforests at a staggering rate. And the main issue with all this is the top level climate change. So on the left-hand side, we've got the change in global temperature. It looks like quite a scary chart, actually, but it only factors in a change of 1 degree Celsius around the globe. But actually, that 1 degree has a huge impact. We're seeing polar ice caps melting. We're seeing extremes of weather, like Carla mentioned, the fires in Australia. Those incidents are becoming more and more frequent as time goes on. And it is purely human factors that are driving this issue. On the right-hand side of the screen, you've got the atmospheric CO2 concentration. Carla mentioned we have to decarbonize as an economy, as a global economy. It has to happen. And over the this is a 400,000 year chart. And as you can see, the amount of CO2 in the atmosphere, it trends in cycles, so it tends to peak around 300 parts per million before dropping back off to sort of 180, 190, then peaking again 100,000 years later. In the last 50 years, we've seen that spike rapidly up to 400 parts a million. And this is just clearly unsustainable and something we really need to do something about. Okay, so when we talk about consumption of the Earth's natural resources, what do we really mean, and how fast are we getting through these resources? So if you look back to 1970, we were using the world's natural resources at about the same rate that the ecosystem could regenerate. So one Earth is what we were using at that point in time. Today, we're using the Earth's resources 1.7 times faster than the ecosystem can regenerate. That is an unsustainable trajectory. And in fact, if the whole world lived like Americans, that number would be 5 times. So we'd be using the natural resources 5 times faster than the world can replenish them. I think that's quite a staggering statistic, to be honest. And the fact it's increased so rapidly since the 70s is quite unreal. But it's not all doom and gloom. You know, as Rob said, we want to be part of a world worth living in. We want to invest in that world. And this is about investment and investment opportunity. So the Industrial Revolution in the 18th century saw significant changes to how the world worked and how people work themselves. Since then, you could argue there's been a number of other sort of industrial revolutions. And the last one that we had was surrounding IT, telecommunication, and of course, you know, the internet. And I'm sure you can all agree that recent technology has changed the world we live in dramatically. Even now during this pandemic, where we're all locked in our houses, you know, we wouldn't have been able to do these sorts of things not too long ago. But as with anything, you know, whenever there's change in society or change in the way people work or businesses operate, that creates opportunity. And as we move to a lower carbon environment, I think there will be significant investment opportunity from those sorts of companies that change the way they work and look to be more environmental and socially responsible as we move forward in time. So what is responsible investing? You know, how do we go about it from a fund management point of view? Well, the old name for this was ethical investment, and that's been around for quite some time. And it used to be a case of you would just take out things that were damaging or seemed to be damaging to society, such as alcohol production, tobacco, things like that. And you would be left with what looked like a normal portfolio with a few stocks missing. In more recent times, that's transitioned into what we call ESG, or environmental, social and governance investing. And this is where we look at all companies, good and bad, and screen them for a number of different factors to make sure that they are doing things in the way that we want them to do it. You know, why do we want to invest responsibly? Carla touched on a number of points earlier, and actually Rob mentioned a statistic also in his video of this 27 times the impact. I mean, we can all do things in our personal life. We can eat less meat, we can cycle to work, we can drive an electric vehicle, we can fly less, or in the current climate, don't fly at all. But all of these things have a negligible impact compared to what you could do if you simply transition your pension portfolio from a normal portfolio into a responsible investment portfolio. And why is it important to engage with companies? The capital level, why is it important to be an investor? Well, you have a voice as an investor, and we have voices as fund managers, so we can directly influence what companies are doing through voting rights at AGMs and shareholder meetings, rather than just sitting on the sidelines and hoping that companies start to change the way they work. You know, you can have an active role in making that change happen. And also, you know, investing for the futures is really important in terms of stock markets change in terms of the composition. So if you look back to the stock markets of 10 years ago, 20 years ago in particular, the companies that were at the top of the stock markets, they're the biggest companies, were very different to what they were 10 years ago and very different to what they are now. And we think that in the future, those companies that embrace these ESG factors will be companies that reap the benefit of that going forward. So we want to be investing in companies that are doing well, because after all, you know, we aren't just investing responsibly for the good of the planet and good of society. We are doing it to generate an investment return as well for those assets. So how do we go about doing it as a fund manager? Well, there are different ways of doing it. You've got restriction screening, which is sort of the old ethical investment philosophy of taking out stocks that are seen as poor for the environment or bad for society. You've then got integration of responsible investment criteria over your normal financial analysis. And that's a really key point, because we don't just invest in a company because we think it's good for the environment or it's good for society. It has to still have a good investment thesis behind it, like any company we would invest in normally. So it has to look good as a valuation has to look good. It has to be a high quality company. It has to have growth prospects. All these factors need to be filled first. and we then overlay the responsible investment framework on top of that. Thematic exposure can be quite common with responsible investment. You get things like sustainable energy, food production as themes that generate returns and will be included in portfolios in different areas of the world. And impact investing tends to be more towards the ESG factors and less about the financial gains. So they do appear from now and again within portfolios, but that they are quite limited in what we use them for. Nonetheless, Rowan Dartington, we use all these approaches when it comes to constructing a responsible investment portfolio. You have to be very pragmatic with ESG, and a lot of the subjects that we will cover the types of stocks and sectors that we include or exclude. It can be up for debate. Some people have a view that you shouldn't include some things that we do have, whilst other people are a little bit more relaxed in their attitude to what should be screened. On the left-hand side of this slide, you'll see this is sort of like the old ethical investment type of things. What do we negatively screen for? So what companies do we look at and say, right, we can't have them because they damage the environment? And even those can generate challenges. A couple of examples would be alcohol. We won't invest in companies like Diageo for our ESG portfolio. They're an alcohol producer. That's the main bulk of their business. But then it's how far you want to go with that screen. So you could say, well, we shouldn't really invest in Tesco because Tesco's as a supermarket sells alcohol. We shouldn't invest in anyone that has a forecourt because they will also sell tobacco. It's how far you want to go with this. And so we use a technique called major and minor influences. So if a company is a major producer of those products, we'll exclude them. If it's a minor influence on the overall business, which it is for Tesco, we'll then include that company within our screening process. And it gives you a much wider universe to work with them. Another example here is animal testing. So we don't invest in anything that tests on animals for cosmetic purposes. However, we do invest in companies that use animal testing for medical purposes. And again, I think in the current environment with what's going on, we're trying to generate a vaccine for COVID-19 as quickly as possible. I don't think there's that many people that would sort of argue against doing so. However, it can be a stumbling block for some clients. And if that's the case, then we can more rigorously screen the portfolio to try and take out those aspects as well. When it comes to things to do with society and making sure that people are treated in the right way, that also ties into can also tie into stocks that are environmentally friendly. So there's no doubt that we need to, by decarbonising the economy, we need to move to electric vehicles and move there relatively quickly. The consumption of fossil fuels is one of the primary drivers of CO2 concentration increasing in the atmosphere. But to produce electric vehicles, you need a lot of copper. And to get copper, you need to get it out of the ground, so you need a mining company. Now, mining companies historically have been quite poor for the environment, and they would fall foul on an environmental damage screen in one of these portfolios. But again, pragmatism comes to the fore here. We must move to electric vehicles, therefore we must have copper. We can't just create it out of thin air, so we have to dig it out of the ground. So in that sense, we would then take some mining companies in order to produce that copper. However, this is where you come to what we call a best of breed mentality. So instead of just saying, okay, we need copper, let's just buy whatever copper mining companies are out there, especially given that some of these companies, or a lot of these companies, operate in sort of developing world. You then look at that company and say, okay, we've got a copper mining company here. How do they look after their employees? Do they provide healthcare? Do they provide accommodation for those employees? What's the remuneration like? Do they have pension schemes in place? All of these factors combine to say, okay, it might be a mining company. We might not like the fact that it has some environmental damage implications, but they look after their employees well. They try and do things in the cleanest way possible, and therefore it fits much more nicely with what we're trying to achieve with this portfolio. On the positive side of things, this is much more recent, the positive screen in terms of how ESG portfolios are run. And it's trying to actively look for those companies and those funds that are engaged in things that are positive for the environment or positive for society. And a good example here would be sustainable energy production, so investing in solar farms and wind farms, which produces a sustainable income The capital value doesn't change quite significantly as other stocks in the market, but great income production. A lot of it is government backed, so it's reliable income generation, and it's there for long term. You know, regardless of what's happening in the economy, the sun still shines, the wind will still blow, and they're a great asset to have alongside other assets within a portfolio as a diversifying factor. So how do we go about doing it and constructing the portfolio? Well, as I've said before, we have a broad approach. You have to be pragmatic when you're investing in these sorts of themes. But we primarily come at it from two angles, what we call bottom-up and top-down fund management. So the bottom-up research sits with the analysts, and we have a team of equity analysts and fund analysts, and their job day in, day out is to monitor companies and funds and make sure they meet our relevant criteria. And for stocks, that would be, again, those growth aspects, where they are at the moment in terms of stock value, how high the quality is of that company, the management team, any good, what's the management track record, and they will rate all the companies that we research from buy through to hold, reduce and sell. The funds, so the fund analysts do the same thing with collective funds from around the globe, and we'll have a bench list of funds that are waiting to move into a portfolio at any point if the funds that we currently invest in start to do things away from the investment strategy that we are used to them pursuing. The top-down decision then comes from the asset allocation committee. So once a month we will sit down and we'll say, okay, we've got portfolios that range from low risk up to high risk. And for each of those portfolios, we'll allocate assets to different asset classes. And the asset allocation's job is to talk about the global macroeconomy, the relative valuation between asset classes. So is fixed interest looking expensive versus equity versus alternatives? And then also within the equity content, which countries are looking more expensive or which areas, and what should we be looking to allocate to in the coming medium term. Now, with all the restriction that I mentioned in the previous slides about the things that we screen out and the things that we screen for, you might think actually, well, what is there left to invest in? If you take all those companies out, aren't you left with a very bare bones portfolio? And how's that possibly going to generate any sort of return moving forwards? And here are just a few of the investment themes that actually you can have within an ESG portfolio that are present now and will no doubt be more important going forwards. Give you a couple of examples. So smart metering is a theme. It's a company we use that, you know, they have smart meters in homes where you can measure your electricity usage. It's doing quite well. We're also looking at another company at the moment which uses satellites to look at farmland and measure where which areas of those farmland needs fertilizer. So instead of the farmer just going out and fertilizing all the land, using a lot of fertilizer, which we know is poor for the environment, it allows them to use less fuel for the combines and the farm vehicles to get them to certain areas that need the fertilizer, and then fertilizer usage is also reduced. So food production is maximized with the minimum amount of environmental damage. So there's a few different things that we can work with as we move on. From a sector point of view, the equity content of the portfolios, you would expect there to be certain areas that wouldn't appear in these sorts of portfolios, as I showed you in the screening earlier. So if you look over to the right-hand side, the active share is where the portfolio would be underweight or overweight, so it has more invested in certain areas or less invested in certain areas compared to the UK market as a whole. And the obvious ones are there really. So consumer goods, the underweight position there is because we don't hold tobacco producers, the alcohol producers that are such a big part of the FTSE 100. Basic materials would be those mining companies that we don't think are doing well enough for the environment. And oil and gas is a big one. So we don't invest in oil and gas producers for the two reasons of environmental damage and fossil fuel production. And actually that's it's been a positive factor this year for ESG investors as a whole, because given the oil price shock and oil going to a negative price on US futures at one point, oil producing companies have not done so well. So the fact that these haven't been in the portfolio at all has been of a benefit to responsible investment clients. But we are a discretionary fund manager. We are running a portfolio primarily for long-term returns for clients. Therefore, we have to approach this like we do with any other portfolio. It has to be a diversified portfolio across different asset classes with different exposures. So not only do we screen the UK equity component of our portfolio, which would be invested directly from the FTSE 100 all the way down to the AIM market, depending on which companies we favour at any one time. We also add in a lot of global equity exposure, which would cover America, Europe, Japan, Asia, and the emerging markets. And then we would diversify that. So depending on how much risk the client wants to take, and that would be a discussion that we'd have with Carla. We will then add fixed interest alternatives and a cash weighting to make that portfolio lower on the risk scale or higher by reducing those areas. So fixed interest investments would be your likes of government bonds, corporate bonds, lower volatility assets there to dampen the movement in stock markets. And alternative investments would be things that generate returns from a different source. So you would have things like the solar power we discussed earlier, property. Some hedge funds would make it in there, sort of lower volatility hedge funds, infrastructure investments, things like that. So hopefully that gives you a feel about what we're trying to achieve when it comes to responsible investing, the goals there and how we go about actually constructing a portfolio for a client, because ultimately we're trying to maximize returns for you as a client over the longer term, whilst investing in those areas that we think will be beneficial for the environment and for society going forwards. I'm just going to touch now on the current market environment, what we think is happening, and try to put it in perspective over the longer term, because we are definitely, investing in uncertain times. The recent, last 3 months have been pretty unprecedented in terms of our lifetimes, and it's quite natural to be concerned when we have fluctuations in stock markets. The one thing that is certain is that stock markets do fluctuate. We have volatility all the time. And actually, the key message during this little slide deck is that time in the market is far more important than trying to time the market, because as human beings, unfortunately, we are awful at timing the market. If we revert back to natural behavior, and unfortunately some people do get caught up in this, if they don't sort of get contrary advice at the time, people tend to pull their money out at the worst possible time after it's dropped significantly because of fear. And they then wait until things look a little bit more certain, the stock market starts to rally again, and then they decide, actually, we want to be invested again. And they'll buy in at a much higher point, typically actually the peak of the following rally, once the markets have already moved. And we get these short-term fluctuations in markets all of the time. So if you just look at the chart, the blue bars and the red bars, blue bars indicate positive returns, annual returns for the FTSE All-Share. The red bars were negative years. You would see, well, that's easy. I could have sold at the start of 2008 and bought back in at the start of 2009. I would have made a fortune. Unfortunately, it's not quite that simple. So if you look down underneath the bars, you'll see the orange dots, and the orange dots indicate the peak to trough movement of the market within that calendar year. So if I just flag a couple up, for example, so in 1987, at one point in that year, the market was down 35%, which is getting on for the worst stock market drops in history. By the end of the year, the market was up 8% on that calendar year. In 2009, the financial crisis, the market was down 21% and then ended the year up 30%. Now, if you're able to time those movements, then you're a far better investor than I'll ever hope to be, and also far more intuition about markets. But if you were to just hold your investments through those periods and ride the volatility, maintain your long-term goals, be rational, although it can be hard to do when things are moving about like they do. And the way we need to be the reason why we need to be rational and look at the long term is because over the longer term, the odds have favoured the investor. So 74% of years, markets have had positive returns. So by being invested for longer term, you will benefit from those returns. Now, no one likes uncertainty, and the stock market in particular doesn't like uncertainty. Now, despite the uncertainty we've had with the COVID-19 pandemic and the effect, more importantly, the effect of lockdown on the economy, is there anything that we can be certain of at all during the current period? Well, if we look at what actually happened, the speed of the fall in the stock market back in March was staggering. I was investing assets through the financial crisis, and that was a really testing time for me as an institutional fund manager. but it took the market 188 days to go from where it was, the peak, where it was in July 2008, to the trough early 2009. With COVID-19, the market fell from peak to trough in 16 trading days. That's absolutely unheard of, and it's probably the reason why it generated so much panic in the market and so many people fled to cash. Now, there's probably a few reasons for this. One, money moves a lot faster these days than it used to. So if you think 20 years ago, you would have to send a message or phone your stockbroker. They would then walk around to the exchange and place the sale of your stock. It takes a bit longer. Now, you can just get your mobile phone, go on your trading app, sell all your stock within a few minutes, and it's done. And we also have a lot of algorithm-based hedge funds that require no human intervention that will automatically shift billions of pounds from positive positions even to full short positions in the blink of an eye. So money moves a lot faster, and that compounds the effect that it has on daily pricing. I think what we saw this time as well was because a lot of people were furloughed or isolated or working from home, we saw the amount of market participants decrease significantly. And whenever you get a decrease in participants, you get a decrease in volumes. The stock markets work on volume basis, so there's a load of trades going through the purchases, a load of trades going through the sales. Stock prices tend to sort of level. You get a nice mid price. It's nicely balanced between the bid and the offer. When there's hardly any trades going through, the difference in pricing between the purchase price and the sale price can be significant, and that will have a huge impact on the daily return of that stock. So what can we be certain of? So we don't know how this is going to play out. We don't know how quickly the economy will respond to what's going on, or how quickly these company share prices will bounce back. So what we've got to do is look back to history and say, well, what happened during the last periods where we've had significant market volatility? Global financial crisis back in 2008, 2009, market was down 46%. Eurozone debt crisis in 2011. Then we had the Brexit vote, the US election 2016. And then with Donald Trump and his trade war with China and US interest rates rising in 2018. These were all sort of recent periods of volatility. COVID-19 minus 30%. What happened in the periods following that volatility? Well, 3 months later, all the markets were up, double digits. 6 months later, they're getting a lot better. 1 year after those four incidents, markets were significantly higher than the trough. If you look at the 3 year and the 5 year figures, these are annualized returns. So that is the broadly speaking, it's the average return that was achieved over the 3 and 5 years following those incidents. Double digits per year for 3 years and for 5 years. Now, we don't know what's going to happen with COVID-19, but if we look at history, one thing that we can be certain of, the stock markets will be higher in value going forwards than they are today. That's why it's important to watch the direction of the tide and not the waves. So this is a chart of the stock market that goes back to the 70s. And if you look at Black Monday, October 1987, it looks like a small ripple on this chart. Tiny ripple compared to the later instance that we've had. Now, I wasn't managing assets in 1987. I was 5 years old at the time. I was probably more interested in watching Transformers or something on the TV, but I can guarantee that the people that were investing at that point didn't feel to them like it was a small ripple on a much bigger chart. It probably felt like the end of the global capitalism as we knew it. And it's the same during every period of volatility we have. It always looks like things are going to end. Now with COVID-19, it's very different because with the financial crisis, there was a structural issue with the financial system. Banks were going bust left, right, and centre. They were undercapitalised. The central banks eventually did step in and try to stem the tide with the QE, but it was a little bit slow to happen. And investors had other options, so you could go to cash and get a better return than you could today. You could go to bonds and get a better yield than you can today. And now we've got a phenomenon where if you're an investor, and particularly an investor after income, there's not really anywhere else to go. Equities, despite the dividend cuts that we've seen, which we're hoping will be temporary dividend cuts to retain some cash flow in businesses, I think that's pragmatic. If you're an income investor, you're getting negative yields from bonds, you're getting no yield from cash, So where are you going to generate your income from? The answer is you've still got to be invested in equity. So I think given that and the fact that the financial system is stronger these days, banks have had huge capital buffers put in place since the financial crisis to ensure that didn't happen again. Governments and central banks stepped in a lot more quickly this time in order to stem the flow of the impact on markets and the economy. No doubt we will go into recession, but actually, because it's less structural this time, event-driven market volatility tends to recover much faster than structural market volatility, although only time will tell. I'm just going to finish off with a quote that I quite like at the moment, which is, "Be aware the market does not turn when it sees light at the end of the tunnel. It turns when all looks black, but just a subtle shade less black than the day before." And this goes back to my initial point of time in the market rather than trying to time the market. If you wait for things to look a little bit more clear, or the world to look rosy, the stock market will have already moved and you'll have missed a subsequent rally. So I hope that gives you, an idea of how we go about responsible investment. I hope it was useful for you. I'm happy to take any questions in the chat, or we can pick up questions later on. Thank you.
Thank you, James. That was really interesting. If you just stay with us for any questions. If you do have a question, just type it into the Q&A box at the bottom of the screen. It could be either the bottom or the top of the screen, depending on your system, but just type your question in there. James, I think there were some really interesting themes that you picked up there. I think, about the acceleration and the pace of change is quite startling, how quickly things are changing. And also around the screening, sort of what traditionally we use negative screening when we're looking at ethical funds, whereas now we're using money as a force for good and looking at the positive screening, which I think is fascinating. Making our money do something which is creating a better environment is brilliant. I'd also like the themes about investing for the long term, and clients do need to remember that when we do investment portfolios for them, we are designing them to meet longer term goals and objectives, and really the short term noise should just be ignored. We understand it's unsettling, of course it is, but have the confidence in the longer term strategies that were created, because as long as those goals haven't ultimately changed, then the portfolio should still be fit for purpose. So thank you for that. Just a question here that's come through. Just put this one to you, James. So historically, so-called ethical funds have underperformed against traditional mainstream funds. Why is that? And why do you think that's now changing?
Yeah, it's a good question. And I think it was definitely the perception of ethical funds in history was that they underperformed. I think it comes down to a couple of factors. The first would be, like I mentioned earlier, that the composition of stock markets in the past has been very different. There weren't that many companies that were focused on doing things well. So the positive screening aspect really wasn't a thing. Companies weren't that bothered about what their impact was on the environment and society, as long as they were generating profits for their shareholders. So if you were investing in an ethical fund back then, you didn't have any positive screening. You were just taking out a number of stocks from your portfolio, and things like Diageo, which wouldn't be in one of those ethical portfolios, that's done very well over time. British American Tobacco, Imperial Brands, those sorts of tobacco companies have had a phenomenal growth over the last 20 years. But we're starting to see that industry change for the better. They're not quite there yet. Obviously, people still smoke, but it certainly hasn't got the impact that it had on stock market growth in the last 20 years. So I think the composition of markets changing definitely helps with performance when it comes to ESG investing as we know it now. And actually our ESG portfolio has performed broadly in line, and in fact is doing a little bit better now given the lack of oil exposure than our sort of standard medium risk best ideas template. So it's certainly not a factor going forwards as more companies try to do things in the right way.
Brilliant. Thanks for that, James. I don't think we've had any more questions, but if any come through afterwards, I'll send them on to you and we'll get back to anybody who has asked a question. So I do hope you've all found that interesting. Let me just share my screen. So the next webinar we're planning will be in a couple of weeks' time. The topic is wills and trusts. So we sent out a survey which clients responded to, and the topic that people most wanted to see was around wills and trusts and estate planning. So we are planning on those. So the next topic is wills and trusts, and we'll be joined by Michelle Tong from JMW Solicitors. So there'll be an invite coming out on that very soon. So please do keep an eye out for it with the email and the link to register. And again, pass on to any friends or family that you think might benefit from that. And again, just a reminder, at Oakmere, it is now business as usual. We're able to carry out all our meetings by phone or video, and most of the paperwork can be completed electronically now. So please do just get in touch with us. Every member of my team, as always, would be delighted to have a chat with you. So finally, just want to say thank you, James, for giving us your time today, much appreciated. Thank you all for attending, and please stay safe. Thank you.
you.